Last year, 29% of Buy Now, Pay Later users split their grocery bill into installments. Not electronics, not sneakers, groceries. 13% used it for rent. 20% for restaurant delivery. Dinner, financed in 4 pieces before the food even arrived. And nearly half of all users, 47%, paid at least one of those little installments late this past year. Buy Now, Pay Later is now a $128 billion market in the United States, and it is still accelerating. 47% of American adults have tried it. 63% of users carry several of these loans at once. 54% say they need it to make ends meet. That is not a checkout button anymore. That is a lifeline. Strangest of all, until very recently, this entire mountain of debt was invisible, not to you, but to the whole banking system. This is how 4 easy payments became America's fastest growing way to borrow, and why the number 4 is the entire secret. Because none of this is new. The trick is over 150 years old, and it started with a sewing machine. In the 1850s, a Singer sewing machine cost more than most families could hand over at once, so Singer stopped selling machines outright. It sold payments instead, a small deposit, regular installments, take it home today. The installment plan was born at industrial scale. It worked so well that installments spread to furniture, pianos, radios, cars. Owning first and paying later became the American way. Then the Great Depression flipped it. Stores invented layaway. Pay in installments first, and only then take the product home. Layaway was buy now, pay later in reverse. The store held the risk on a shelf, not on your shoulders. For decades, that was the deal for cautious shoppers. Then, credit cards buried layaway. And waiting went out of fashion entirely. In 2014, 2 Australians, Nick Molnar and Anthony Eisen, launched Afterpay and quietly resurrected the Singer playbook for the internet. Their version: pay 25% at checkout, then 3 more slices every 2 weeks. No interest, no paperwork, no waiting. It spread through online fashion like wildfire, and when the pandemic pushed all shopping online, it detonated across the entire economy. But Afterpay's real innovation was not the app. It was legal. It was the decision to stop at exactly 4 payments. American lending law has a bright line, drawn in 1968 by the Truth in Lending Act. It defines what counts as credit. The law covers loans that charge interest, or loans repaid in more than 4 installments. More than 4. Read that again. 4 payments, 0 interest. In the law's eyes, for decades, that was not consumer credit at all. It was barely anything. No mandated disclosures, and in many states, no lender license required. The Consumer Credit Rulebook simply did not apply. That is why every one of these companies, Afterpay, Klarna, Affirm's basic plan, landed on the same magic structure: pay in 4. The number 4 was never about your convenience. It was the exact width of a gap in a 1968 law. Regulators eventually noticed. In 2024, the Consumer Financial Protection Bureau ruled these plans must follow credit card protection rules. New York followed in 2025 with the first state license for pay later lenders. Illinois signed its own law this month. But by the time the rules arrived, the industry had a decade's head start and hundreds of millions of users worldwide. Which raises the obvious question: if they charge no interest, how does anyone make money handing interest-free loans to strangers? Here is the quiet answer. You are not the customer. The store is. And the store pays handsomely for you. A merchant pays roughly 2 to 3% to accept a credit card. Pay later providers charge between 4 and 8. Why would any store hand over double or triple the fee? Because splitting the price changes what shoppers are willing to buy. A $135 cart, the average pay later purchase, becomes 4 easy payments of about $34. The weight simply vanishes. Shoppers hesitate less, abandon fewer carts, and spend more per order. The merchant's fee buys a customer whose brakes have been removed. The psychology is the product. The pain of paying is sliced thin, moved into the future, and scattered across your calendar. Late fees add another stream. And remember, 47% of users paid late last year, up from 34% just 2 years earlier. PayPal, Affirm, Klarna, and Afterpay now sit inside most big checkouts, each one a toll booth on the removal of hesitation. 54% of users now admit regretting at least one purchase they financed this way, up from 48% the year before. And all those sliced payments piled into something the financial system literally could not see. It even earned a nickname, phantom debt. For most of this boom, these companies did not report your loans to credit bureaus at all. No balances. No late payments. Your bank could pull your file and see a clean record, while you quietly owed 4 different apps $600. Regulators called it a credit blind spot. 63% of users carried multiple loans at once. A quarter carried 3 or more. Loan stacking, they call it. Because no provider could see the others, each one happily lent as if it were your only debt. The people leaning hardest are telling. 69% of parents with young children use it. 61% of Gen Z. Even 59% of households earning over $100,000 a year. This is not a fringe habit. It is the mainstream. In spring 2025, the wall cracked. Affirm began reporting every loan, even Pay in 4, to Experian and TransUnion. Klarna now reports its longer loans. Afterpay, notably, still reports nothing in the United States. The blind spot is shrinking, not gone. FICO built 2 new credit scores just to read this data. The first scoring models in history designed around pay later loans. But here is the twist. As of the middle of 2026, most banks still do not actually use those new scores. Your on-time payments sit on your file like a parked car, recorded, visible, and doing absolutely nothing for your number. So where does that leave the 4-payment economy in 2026? Read the 3 numbers that moved this year. Late payments, 34%, then 41%, then 47%. 3 straight years of climbing. That curve is the whole story. Groceries bought on installment, 14% of users 2 years ago, 29% today. The loans migrated from wants to needs. And the market itself is projected to double again, to roughly $258 billion in America by 2031. None of this makes Pay in 4 evil. Used once, paid on time, it is genuinely free. The merchant covers your ride. But free for one purchase and free as a lifestyle are 2 different products. One is a tool. The other is a treadmill. The Singer Company understood it in the 1850s. The installment is not a favor. It is the most effective selling machine ever built. So the next time a checkout offers to slice a price into 4 painless pieces, notice what is actually being sold: your hesitation. The system that finally sees this debt is only now switching on. What it reveals about American wallets will be next year's story. Next time, the credit score itself, the 3-digit number that runs your life, and the strange math behind it.